Good morning, everyone. Everybody here at West San Gabriel? Yeah. You
3 seconds.
guys are in for a treat today. So let me introduce our speaker today, which is Tracy Shaw from Prestige Capital. Tracy Shaw is the founder and owner of Prestige Capital, a trusted mortgage company serving clients throughout the San Gabriel Valley with over 10 years experience in the mortgage lending industry. Tracy brings a wealth of knowledge and track record of success in helping homebuyers secure financing that truly fits their needs. She is well versed in all types of loan programs and deeply familiar with the real estate transaction process from start to finish. Tracy is known for her reliability, responsiveness, and hands-on approach, making her a valuable partner for both agents and buyers alike. Over the years, she has built a strong reputation for local market by consistently delivering results in guiding her clients throughout every step of the mortgage journey. And enduring her deals close smoothly on time. Her commitment to excellence and client care has made one of the most respected loan officers in the region. Please, let's welcome Tracy Shaw.
Woo! Thank you. Thank you, Mark, for the wonderful introduction. Hi, everyone. This is Tracy from Prestige Capital. Today, I'm going to share a few points. It will be divided to 5 parts. First is getting to know each other. Second is loan program we offer. Third is how we can close more deals together. Fourth is interest rate outlook 2025. And at the last, we'll have Q&A. We also have pizza delivery later, so please make sure you stay until the end. So getting to know each other, the first one. I have been in the lending and real estate related industry for more than 10 years. I had my real estate broker license for I believe it's like 12 or 13 years ago already. And I switched to lending about 8 years ago. So myself, I had experience of being a real estate agent. So that helped me with the lending partner up with the real estate agent as well, because I understand every single parts of the transaction, escrow, title, how to talk to listing agents, selling agent, clients. So that makes it I think that part makes me stand out as a loan officer, so I can understand real estate agent and the client's needs more in like every single angle. So that's something about me. And maybe can I have somebody introduce about yourself a little bit? Maybe the lady at the second row. Can you please briefly tell us like what is your name and which company you work for, and what kind of transaction you do for most of the time? You could just, yeah, depending on you, yeah. Okay. Of course. Thank you. Thank you, Mr. Lee. Yes. So the reason we being here today is to discuss what we can do for you guys and how we can work together. So moving to the next part, I will share loan programs we offer. I will go over all the programs, and we do have some programs helping with Mr. Lee's clients as well. So loan programs we offer, all the lenders, mortgage companies offer full documentation loan. Full documentation loan is for any mortgage loans that we check full documentation, which means 2 years tax return, W-2, 1099, all kinds of tax return stuff. We can do 5% down for full documentation, and the fastest closing myself was 11 calendar days. I have closed jumbo loan in 11 calendar days for full documentation. We also have 0% down payment for veterans loan. I believe somebody asked me about the 0% down earlier. So for 0% down, VA program, which is for veteran, that is very attractive. A lot of people having doubt, like, okay, if VA loan they are slow or they don't have good terms. Actually, VA loan is one of the loan I have been done. They have great terms. They don't have a lot of delay for the closing. And we can even finance sometimes more than 100%, which means besides the 0%, yes, the veteran, they will also get closing cost wrap up in the loan amount. Moving to the next segment, it's a non-QM. So right now, since ever since pandemic, before pandemic, we already have a lot of non-QM loans. After pandemic, we have more non-QM loans. Like right now, I would say in my pipeline, more than 50% are non-QM loans. The reason being is from a personal perspective, I think there is a huge part with inflation, because right now the inflation is like so high, the price for the housing market goes up so much, and also the interest rate. The interest rate is better than last year, but it's still about 6 point something, and the wages and earnings are not really going up a lot. So with full documentation, a lot of people cannot get qualified. That's why we have non-QM loans. So non-QM loans basically, we do not check tax return, but we do check some type of documents, such as, okay, there's a few different non-QM loans, such as DSCR, 12 months bank statement, VOE, P&L stands for profit and loss. So who knows what does DSCR stands for? Yeah, great job. So yeah, debt service coverage ratio. So that means we only use the debt and the coverage ratio to qualify for a mortgage. What does that mean? That means that we will calculate how much this investment property, this is only for investment property only. So we will calculate for this investment property, how much do we need to cover the cost to run this kind of investment property, such as property tax, mortgage payment, insurance, HOA, PITIA. And we will compare that with the actual rental. If the rental will cover all the costs, then that ratio is 1. If the rental will not cover the cost, then the ratio is lesser than 1. So the lowest DSCR we can do, I believe it's around 0.8. However, DSCR loan right now for California, especially in LA County, is very, very rare. I have done a lot of DSCR loan around 2020 and 2021. The reason is because the interest rate was so low. Because when the interest rate is low, your cost of holding an investment property is low as well. So you can get qualified with DSCR. But right now, the interest rate is so high, and the rental income in California is not that good, especially in LA County. So it's very, very hard to get DSCR. However, there are a lot of people, they invest properties outside of California. And there's a lot of people using DSCR program to purchase investment property outside of California. The rate is very good. And if you have any clients, they are purchasing investment property outside of California, then maybe we can discuss that. Let's move to the second one, that is 12 months business bank statement. 12 months business bank statement is only for self-employed only. And what we need, we only need 12 months business bank statement or 24 months, whichever shows more cash flow. However, it's a little bit tricky if it shows more cash flow 2 years ago and then you show us in the last 12 months it's going down, then there might be some question about the cash flow. So we use only the 12 months business cash flow, and we have our own calculation to calculate how much this business is really earning instead of using the tax return. Because on the business tax return, a lot of people, they have a lot of expense. They deduct a lot of expense. And the best thing about this one is that we can do as low as 10% down payment. End of last year, I helped my clothing alteration lady purchased her first home because we were just like casually chatting when I was picking up my clothes, and she's like, "Oh, how's the market?" And like, she really wants to buy a house, and I'm like, "Maybe you can do it." And she was like, "Okay, I don't have that much saving." But I go to her store a lot of times, so I can see she has very good business. So I encourage her. I'm like, maybe you can share like your business tax return, and I help you. And end up like they were very happy. I was very satisfied and rewarding emotionally as well, because they have lived here for like more than 30 years, and they have this dream to purchase a home, and they don't have the savings. So end up like she only put down 10% down payment, and we help her get qualified for the purchase loan. So for a lot of self-employed, they thought that they cannot get qualified for a loan, but that is not true. There are so many different programs we can do. So moving to the next one is a profit and loss statement for self-employed. So some people, their business bank statements cash flow might not be very consistent. Like for example, some real estate agents, they have their own company to like they get 1099 and they establish their own company. They like real estate agent are considered as self-employed as well. So if the self-employed can provide profit and loss statement from the CPA, we have two programs for the profit and loss. One is the CPA prepared profit and loss for last year and this year to date. The second one is self-prepared. So we can use both. Of course, if the CPA can prepare it, you will always have the best interest rate. The interest rate starts at 6.375 as of today. The full documentation loan is also at 6.375, 6.5 like this week. So the interest rate is very, very compatible. And moving to the next one, we also have VOE. VOE is called Verification of Employment. Verification of Employment, this kind of program is not for self-employed, it's for wage earner. So we need the employer to verify the employment as well as their income. What is this kind of program good for? It's good for people who maybe they earn cash or they have a lot of tips. So this VOE program is very popular as well. So moving on to the next one, what if a client cannot get qualified with full documentation and they cannot get qualified with stated income? We also have hard money loan. So for hard money loan, the 1 month interest rate starts at 6.99. The 2 months one starts at 7.99, and the 3 months is 8.99, 12 months is 9.99. This interest rate, all the interest rate I'm stating today might be changed, like due to like the market change. When we talk about interest rate, it's always like it's a starting rate. It will be adjusted according to the credit score and a lot of other factors, and it's always subject to change before it's locked. So for the 1 month, 2 months, and 3 months, this type of hard money is very good for investors. A lot of people, they buy off-market deals. and they need to close very fast. They have to close maybe 3 days, 4 days. We can do that. However, for 1 month, if they decide to do 1 month, they have to pay off within 1 month, and they cannot renew it. They need to do a new loan. So we need to discuss with the clients, like how long do they really need. And also, we need to know what is the exit strategy. Exit strategy meaning that, okay, so after 1 month, are you going to pay cash or are you going to refi? We can do like purchase with the hard money and then refi later, but we do need to discuss with the client what is the exit strategy. Construction loan, commercial loan, and SBA, we can also do it. The perks about our construction loan, commercial loan, and SBA loan is that besides SBA loan is a full documentation loan only. We have to check 3 years business tax return and personal tax return. However, for SBA loan, the business owner can put down as low as 10% down for commercial property purchase, and it has to be owner use. Owner use meaning that 50% has to 50% or more has to be owner occupied, and they can lease out for the rest of, let's say if it's a warehouse and 50% is owner occupied, the other 50% can be leased out. For construction loan and commercial loan, we can do no doc. No doc meaning we don't check tax return. However, this terms varies a lot depending on the borrower and the property. The highest CLTV, I have quoted a client before, was 85. So what does that mean is that this client, he was purchasing a property like 2 million, and he needs another 2 million to do the construction. And we can do 85% of the 4 million for the loan amount. So that is very aggressive. And the reason being is that that client is very, very experienced. So he showed us his portfolio. He's very experienced for the area he's working on. And he showed us all the property he has worked. He knows exactly what he's doing. So the experience of the borrower is very important. And the property itself, where it's located at, and is very important. And we do need like a pro forma for the calculation. What is the cost? What is the estimated ending value after the project? And this kind of loan are all case by case. So moving to the next one, how we can close more deals together. For myself, I do pre-approval 24 hours during business days after all documents has been received. We can do DU approval if the leasing agent want the DU approval. And DU approval, we do need to pull client's credit. So for DU approval, we do need a little bit more time. But for the pre-approval, myself, I review everything. All the documents, we ask everything, no matter it's non-QM or full documentation, because I think it's responsible for the realtor. To review everything is more responsible for both clients and the real estate agent. And yeah, so I will ask a lot of things, and I will review them all myself. And I also work very proactively to get deal closed on time. Because I know that how frustrated when you go into escrow, like finally, like after showing house for months and in such a competitive market, and then you got an offer accepted. And then there's frustration about like loan. So I have a system. I can put down everybody on a system, and I will update every stage of the loan. When it's submitted, when it's initial approved, when the appraisal is ordered, there's gonna be notifications going out to the agents and the buyers, so everybody's on the same page. And I will also call the client and remind them like every day I want the file to move forward. Yeah. So marketing and co-branding. Like I said or mentioned earlier, I have a client relationship management system I have been using for many years. And once I pre-approved a client, I can also sign the realtor as linked to this client. And I can put them onto a stage. Let's say they have pre-approved and there's email going out to let them know what they need to prepare, what do they need to be cautious of, what they not to do during this process. And once I signed you as a co-marketing partner, when the email goes out, it will show not just my name, it will show your name as well. Moving on to the next sector is Fannie Mae's research. So a lot of people are asking about the interest rate. This research was done beginning of this year. So end of last year, they predict the interest rate to be 6.2. And beginning of this year, they raised it to 6.5. It's very hard to predict the interest rate because a lot of people they ask me. I believe they also ask you guys, and I always tell them before it's locked. It's very hard to say because interest rate does change every day for some programs. Some programs it does change a few times during the day. It's very complicated. It's not just the Fed rate. It's also affected by the news. It's affected by the economy. Just a personal perspective, I think the interest rate gonna stay at what we are for now. I do not think it will drop to 5 point something this year. And I do believe there will be a little bit more inflation. So as you know, when there's inflation, it's very hard for the Fed rate or like the over rate to come down. So that's all the information I want to share. I don't want to bore you guys to like keep talking. So now it's open for the Q&A. You are welcome to ask any questions about all the programs I went over earlier. Okay, so because since this you are talking about very general situation, and yeah, that like the mortgage company or lender or banks, they will never guarantee. The reason being is that it will always be documents. The reason being is that to get a loan funded, it's a very complicated process. There is a lot of things behind the scene. Like for one loan, even for a mortgage loan, a team of maybe 15 or more people are working on it. Because there's a lot of things, and it's stage. It's there. It goes through like different stage. There's two things involved in the loan. First is the borrower. Second is the property. Commercial loan is even more complex. Let's just, because your question is generating all kinds of loan. They always ask stuff. Yeah. Yeah, because you don't have like, I don't know which specific case and what kind of, situation you have went through. And but my point is that it's the same, because my point is that if sometimes the borrower's situation change, nobody will guarantee, because if the borrower's situation, or sometimes the borrower, they didn't disclose a lot of things at the beginning, and during the process, during the loan process, they discovered it. So things changed. And also the property itself, if the value didn't come up right, if they discover for commercial loan, there's like environmental report, if that something comes up. So all the conditions have to be met to fund a loan. So if there's something come up, we have to solve the problem. If the problem cannot be solved, the loan will not be funded.
Experience. I purchased the commercial property. I put 50% down, and after just before the 5 days before the close escrow. And then the lender said, oh, I need another $100,000.
Yeah,
So
but did they tell you what is the reason?
the reason, though, that time I was the self-employee, so they need something, I don't know, I forgot about it. But so when the banker filed the bankruptcy, it made me very, very happy.
Yeah, so there's always gonna be a reason behind it if something changed. Yeah, so since you don't remember the reason, I cannot comment on that. Yeah, but if something happened, there's something changed, like we always let the client know. Yeah, what is the reason? Yeah.
Hi, Tracy. Sylvia here. I have two questions.
Mhm.
Question number one, it's trending again to be waiving appraisals.
Mm-hmm.
Are you comfortable as a lender to recommend to your client to waive an appraisal because the loan contingency is still in place?
That is a very good question. And actually, since last month, I do see a lot of loans, they cannot be appraised at the purchase price. That is a reality right now. And the reason being is that the inventory is very low. A lot of people are competing for one house. The second is that I also talked to the appraiser about this because it happens quite a lot lately. And they were saying, because in some areas, their market price is slightly going down, but some areas is still going up. So when the market is going up, the appraiser, it's very hard for them to appraise for the bidding price because the bidding price might be $500,000 higher than the listing price. Yeah, some of them are like that. Yeah, well, it's for a higher price point. And even for like 1 million single family in San Gabriel Valley area, it's very easy overbid 200,000, 300,000. So the appraiser, how they do appraisal report is they have to use very closely to the subject property and recently sold identical property, very similar. They can only adjust the value like that. They cannot adjust the value according to, okay, what is the contract price. So it's very, very common. So it's really up to the buyer. If the buyer decided to waive the appraisal contingency, they better have more money to put down.
So my
Yeah.
question to that is, as a lender, you as a lender, you're working with my buyer. I'm placing an offer. I want to place an aggressive offer. Currently, right now in Moreno Valley, there's 127 properties listed. So, and they're selling. They're selling within the first 2-3 days. If I say to you, as a lender, I'd like to place an offer for my client, are you comfortable in waiving the appraisal? Would you be comfortable in saying to my client, don't worry, because we still have the loan contingency? So if the appraisal doesn't come in, we're going to go ahead and protect you with the loan contingency. Are you comfortable having that conversation with the buyer?
I'm comfortable having conversation with the buyer, but I think one thing we need to make sure is that they have extra money to cover the difference. Because if the appraisal doesn't come in as the purchase price, we might need the client to put in more down payment.
Sure. So as an agent, I would have that covered because I would have it covered based on the terms. So I have a lottery client right now that has a voucher, and we're waiving all contingencies because the lender supports and saying, don't worry about that. We got you covered with a loan. If the property does not appraise, then we'll get you covered in saying that the loan did not get approved. So you have 4 contingencies. So you have your appraisal and your
Yeah.
loan. Okay. That's question number 1. Thank you. Question number 2, in today's time with compensation, are you a lender that is creative with the buyer when it comes to compensation for the agent's compensation? Are you able to be creative and work it into the loan or not?
Not yet.
Okay. Thank you. Thank you. That concludes my questions. Thank you.
Tracy, nice to see you.
Nice to
I
see
have
you.
also have two questions
Mhm.
related to my construction business. Question number one, I do a lot of ADU constructions, and the homeowners sometimes they have equity in the current property besides I build one at the backyard, and sometimes they don't. So most of the time, it suggests them to use a HELOC.
Mhm.
So they write checks for the construction material and labor as it goes. But what happened if the HELOC and cost of material now has been going up, and it's very hard for me to find reasonable cheap materials to construct my project. Whatever if the HELOC is not able to, as we progress in the further phase of the construction, not enough to cover that whole project at, let's say, 70 or 80%, and then we use up the HELOC line. What do we do? Question number one.
So that is like a question regarding to the budget. So, HELOC loan, we can do HELOC loan as well. HELOC loan, however, the maximum loan amount right now we can do is $500,000. So if your project is very close to $500,000 cost, it's very possible to go over. Then they need to find another way because there's no way we can do more than what is a maximum allowed. It's 75% of loan to value, combined loan to value for HELOC loan, or $500,000, whichever is lower. So the maximum loan amount is $500,000 we can do. If it's went over, we cannot do anything about it. Yeah.
Do you consider the ARV of that project, let's say a 2-bedroom, 1 bath, or 1.5 bath, or the finished product? Would that count into consideration? Because now a lot of appraisers don't want to touch the ADU future value.
For ADUs, we do not do a lot of the future value. For ADUs, we mostly just do cash out or HELOC. But for a regular construction loan, let's say you just bought a land and you want to build something, and you have a pro forma and you show your track record, we can do the CLT loan to cost 85. That's a maximum. That is very, very high. Yeah, but that's not for ADU. Yeah, for ADU, we just do cash out and HELOC. Yeah.
Okay.
We don't consider the future value of the ADU. Yeah.
Yeah, that's a great. Okay. Second question. I also do a lot of remodelings, and I've known several flippers. Let's say they bought a piece of property. Most of the money went into the purchase price and the down payment. And then all of a sudden, Mr. Lee, we need to remodel. We can sell it there in flippers. And let's say I estimate it costs about 100,000. And let's say if the property just bought, there's no equity period on the property. Can they borrow money from you or any lenders to do the remodeling? That will be ARV at some point in the future. So they don't have to come up with additional cash. Is that possible?
They don't have any equity?
Well, let's say I just bought a house yesterday and I remodel it. There's no equity in the house at this point. So, but then they put in all the money already for the down payment and purchase price. So it closed escrow. The house is mine now. I need to fix it. Maybe sell it $200,000 more, $300,000 more. I don't know, but I don't have the money to remodel. What do we do?
Well, you can do the non-QM loan or you can do cash out from other property, because if you want to get equity loans, regardless it's a refinance cash out, it's a HELOC, you have to have equity in that property. The combined loan to value ratio has to be lower than 75%. If it's exceed that property cannot get refinance cashed out. Yeah. And so all the cash out, it's based on two things. Like one is from the property itself. Second, like we also need to check, like if you have like a tax return, if you do a non-QM, it's not owning the property. Yeah, it's also about the borrower. And once you max out the equity ratio, you cannot get a refinance. Yeah, because it's too risky.
I know it's risky. That's why I ran into a couple of situations like that. Let me use some real solid example. Let's say I bought the property for 500,000, and I think after I fix it up, I probably can sell for 700. And I've done that too.
Mhm.
But I don't have the 100,000 or 50,000 or 80,000 or whatever it is on the property to fix it. So they hire a contractor, they say, let's say the contract said it costs 50 or 80,000 to fix it. Where do I get the 80,000 if I don't have any more money?
Well, so the property is
stuff.
there owned free and clear?
Well, yeah, when they bought it, hopefully, if it's free and clear, it might be better because actually then there's some equity in it. It's not free and clear. So
Yeah,
what do
then we
do?
need to see like the ratio. If the loan to value ratio is less than 75, then we can still get the money out. If the ratio is
Can we
already
use a projected value of that 700,000. Let's say they fix it 3 months later. Can we use that number so you can land?
depending on, yes, that question is loan to cost.
Yes.
It depending on who is borrowing it. If that person can show a very strong, very strong track record, and we also will consider if that person has other properties. Yeah, if they don't have experience, they don't have other property, then it's very less likely
Okay.
the loan will happen. Yeah.
Yeah.
Yeah. So, but if that person has other properties that's owned free and clear, it doesn't have to be the subject property. If they have other properties free and clear, if they know what they are doing, they have a very good track record, then maybe it's possible. Yeah. But if they don't have experience, they don't have money, then
Yeah.
that's definitely no.
And I totally
Yeah.
agree with, for experienced flippers, which I have worked with, they do have some other extra cash as a buffer. But for newbies who just say, "Oh, I can flip houses," and I told them, I warned them, I say, it's not for amateurs.
Yeah, yeah, that's true. Yeah.
Don't worry, Mr. Lee. I'll lend you the money.
Morning. Thank you, Tracy. Does your office do vacant land loan?
No,
No,
no
thank you.
vacant land, sorry.
Construction loan,
Yeah,
Just like
construction loan is for like
not a construction build up from the vacant land.
not from vacant land. Yeah,
Okay.
it's from somebody, let's say they purchase a
Mhm.
single family resident. It already has a house on it
Okay.
and they will want to tear it down. Yeah. No vacant land, no manufactured home.
The mixed use lot.
Mixed use lot, like you mean commercial and residential mix?
Yeah, commercial
Okay, that's
lot.
considered like commercial.
Okay.
When what do you mean, like purchase or what do you
No,
want?
it's a vacant lot. You can do commercial on the bottom and housing on the top. You know, your
We don't
office-
do vacant land.
Thank you.
Yeah.
Thank you, Tracy. Do you do the out of state loan?
Yeah, we do. Yeah,
Uh,
out of state we can do DSCR, we can do full documentation. Yeah, we have a lot of yeah, we can do like up to 50 some states, but we need
All
to
right.
check like which
Investment,
states.
investment.
Yes,
so-
investment. Yeah, investment. Yeah.
Great, great.
Mostly for investment because most of our clients they based here, and yeah, everything needs to make sense. Like yeah, so mostly it's for people who live in California and they buying investment property outside of California.
Like today, what kind of rate you can offer today?
If it's full documentation, it's the same rate
Mhm.
as California. Yeah,
Okay,
it's no,
same
it's not.
rate.
Yeah, it's not like California has like a better rate or worse rate. If it's full documentation investment for outside of California and California, it's the same. Oh, also, I want to mention something that a lot of people don't know about it. I do want to share is that because a lot of people are asking about foreign, like loans for foreign national. We do loans for foreign national, and if the foreign national person, like the borrower, they work in the U.S. legally, they file the tax return, we can do full documentation loan. It's exactly the same rate as U.S. citizen or green card holder. Even they are not like, if even as long as they are legally working here, like some they hold like L1 visa and some they hold like different types of visa, but it is the same. There's no difference if they are working here legally and they file tax return as U.S. citizen and green card holder. And we can also do loans for EAD cards. EAD cards is for people who they only have work authorizations. So we can do loans for them as well.
Hi, Tracy. I have another question. If the a property has two owner, one is a U.S. citizen, and then another one is a foreigner,
Mhm.
and the U.S. citizen is a mother and daughter. So can they do refinance and based on the one, the legal status one, or have to be get to the lower levels one? I don't know. What's the standard you guys would?
Oh, yes. So it doesn't matter if they are U.S. citizen or if they are foreigner. What matters is how do they prove their income. If they can prove their income, like full documentation, there's no difference. Even if they are U.S. citizen or if they are green card holder, but they cannot prove their income, then there will be a problem. So we only check first if they are legally here, if they are legally working here, and the tax they filed, or if they can do like a non-QM, like a stated income. So as long as they are legally here, it's fine. Even they are traveler visa, they can do loan. We have different programs for people as long as they can legally come to the US and their visa is not expiring very soon. There's no difference. Sometimes there might be difference of the loan limit. For foreigners, certain visa, they can only their loan amount can only go up to a certain limit. Yeah, but for most cases, there's no difference. It's about how they prove their income. If the foreigner is filing tax return here, they can do like 15% down, 20% down.
The foreign, where is she from? Pennsylvania. No, Venezuela.
Okay.
But they have business, and for them they always collect cash, and their political statuses over there is very unstable. So they always carry so much cash at their home. So there's no kind of like no proof for their income. But their daughter is she just graduated. Yeah. So very very limited income, but it could be proof. So. But they have a 50% down payment at that time when they purchase the property, but they would like to do the refinance right now.
Okay. So you said they have business here, right?
Yeah.
Okay, in the US. Uh-huh. And is it active business?
Not in US, in out of country.
Oh, we cannot verify anything outside of the country. Yes. So they sounds like their daughter will not their income her income might be limited. Yes. So if they do, maybe they can do. There's a few options like if they have a lot of savings, we can do asset depletion. Or if they have business in the U.S., you can do the profit and loss statement from the CPA. Or if they do not have those, like, then yeah, it's gonna be tough. Yeah, because we can only verify business in the US because outside the country we cannot verify it. Yeah, but they can, maybe they just need to wait until yeah, the daughter's like income goes up or something. Yeah, but a lot of people, I want to mention is that we do need to check 2 years tax return for full documentation. However, there are a lot of graduates, they earning very good money. They're earning very good income already. We can do full documentation loan for those kind of people as well. As long as they can provide their graduation certificate. Like let's say if somebody, they just graduated and they started working 2 months ago or this month, if they have a very good degree, they got accepted by Google or Facebook, or it doesn't have to be Google or Facebook. I'm just naming some big company's name. And they have stable income. We just need to see their offer letter and their graduation certificate. If they just graduated like 2 months ago and they starting working this month, before we have the final approval, we need to see the first paycheck. We just need the first paycheck, we need the offer letter, and then we can use their income. So it doesn't have to be 2 years working history for this kind of scenario. Yeah, as long as, well, registered, it will be a little bit tricky. You asked a very good question because for a registered nurse, normally they are not paid by salary. They are paid hourly. So there is a very high chance we'll need a verification of employment from the hospital. Yeah, so if the hospital is saying that, oh, this nurse is paid salary based, then there will be no problem. But if they said they are paid by hourly and you don't have that track record, they have been working that many hours, then it's not a stable income. Yeah, so for full documentation, it's all about stable income. So if they paid by salary, there will be no problem. If it's by hour and they cannot show the track record, they work, like certain hours for such a period of time, then there will be a problem.
Okay, any other questions out there, please? If not, let's give Tracy a big hand and thank you for coming.
Thank you. Thank you, Mark.
And Tracy, we have a little certificate here in appreciation from the Education Committee and the West San Gabriel Board.